Go ahead. Well, good afternoon, everyone. I'm Stewart, Director of Market Access and Trade for IBM in our Government and Regulatory Affairs office here in Washington. And I'm delighted to moderate this afternoon's panel on financial services and cloud technology. We've been hearing a lot from the other speakers today about trade and services, digital trade, and the importance of data. I think it's appropriate now that we look at a specific sector as an example, financial services, and do a little bit of a case study and see how it applies in one specific sector. I'm pleased that we have our two panelists here with us today, Dr. Vijay Bhuvanagiri. He is the Senior Vice President for Enterprise Architecture with MasterCard Operations and Technology, and Stephen Ezell, who's Vice President for Global Innovation Policy at the Information Technology and Innovation Foundation, or ITIF. Many of you are probably familiar with his work and with ITIF, those based here in Washington. Cloud technology has enabled an enormous transformation in the delivery of information technology capability, and it's making possible flexible, powerful, low-cost, on-demand infrastructure in information technology, and it's making this available to small and large companies alike. It's enabling new business models, and it's creating new industries, and it's also helping existing companies to be more agile and more cost efficient. The financial services sector is probably one of the most IT-intensive sectors in the entire economy, but it's actually been lagging in the adoption of new cloud technologies, and our panelists will get into some of the reasons why that's the case. Financial services is also an absolutely critical sector in the global economy. We simply could not have global commerce without financial services. And to look at the size of the sector, it plays a huge role in international trade and services, globally with over $500 billion in exports per year based on the latest data from 2014. Our panelists are going to explore some of the benefits of cloud computing, talk about why the financial services sector maybe hasn't implemented cloud as much as some other sectors, and we'll talk about a little bit, future policy issues and what's possible in application of cloud in the sector going forward. So I'll ask both of our panelists to offer some opening remarks, then we'll get into a discussion. I'd like to ask Stephen if you would open up talking about cloud generally, and then we can kind of phase over into a discussion about financial services.
Great. Thanks, Steve, for the invitation to participate today. So financial services are fundamentally about the management, storage, and transfer of information. And this means that they have long been impacted by the waves of information technology innovation that have roiled the economy and society, with the advent of cloud computing only the latest. Now, cloud computing refers to the practice of providing or selling information technology as a service that is delivered over the internet. Cloud computing can be implemented in a number of different formats, the most common being software as a service, or SaaS, infrastructure as a service, or IaaS, or platform as a service. And financial services enterprises use all three types, and I'll give some brief examples. So software as a service, think online productivity software such as Google Docs, allow users to access software applications over the internet using personal computing or mobile devices instead of storing the software on local machines. For instance, Barclays Bank has converted its entire customer relationship management, or CRM system, for its retail banking operations to a cloud service provided by Salesforce. Infrastructure as a service gives organizations access to secure enterprise-class computing infrastructure that can be scaled to different needs, whether it's scalable computing capacity or storage capacity. For example, many investment banks leverage cloud computing to quickly run complex risk simulations for their long-term debt and equity-backed security positions. For example, the Spanish bank Santander can run these Monte Carlo simulations in just 20 minutes today, whereas it used to take them 24 hours, and do so at half the cost. These types of applications are the fastest growing in the financial services sector. Finally, platform as a service allows users to rent virtualized software development or production environments to efficiently develop and deploy new applications without having to invest in their own expensive hardware or software. And for instance here, Visa uses Pass to help clients securely develop mobile payment platforms. While cloud computing's use has grown in the financial services sector, as Steve alluded to, it does trail other sectors in implementation. For example, a 2015 survey of 102 financial services firms by the Cloud Services Alliance finds that only 61% of financial institutions have developed cloud strategies within their organization, so there's a long way to go. Yet the benefits of cloud computing are clear. Cloud computing can reduce the need for financial services firms to make long-term, high fixed cost investments in their own IT assets, which can both save cost and increase enterprise agility and flexibility. And for example, Barclays Bank estimates that it will be able to reduce its IT cost by 90% with its implementation of cloud. Leveraging cloud can also increase decision-making and time to market, which can mean millions in financial markets where milliseconds can make the difference between profit and loss. And finally here, cloud computing can actually increase security, especially when companies choose to store data in secure data farms run by vendors like IBM, Amazon Web Services, or Microsoft Azure. And these are vendors implementing global best-of-breed security practices. The reality is that bank-grade security is being replaced by Google-grade security. And when you see organizations like the CIA, the Central Intelligence Agency, moving its entire enterprise architecture to the cloud, I think this is going to be safe for financial services firms as well. Now, the growth of cloud computing goes hand in hand with the increasingly important role that cross-border data flows play in the global economy. In fact, in 2015, for the first time, the global value of international data flows at $2.8 trillion exceeded the value of global merchandise trade at $2.7 trillion. And since 2014, more than 1/3 of global financial investments were cross-border transactions. Unfortunately, an increasing number of countries have enacted or proposed barriers to cross-border data flows or the use of cloud computing, such as local data storage requirements, or mandates to use only local ICT facilities in the provision of financial services that threatens to imperil the potential of the cloud in the financial services sector. For instance, Venezuela and Russia have passed regulations requiring that IT infrastructure for payment processing be located domestically. And despite some modest improvements, a recent National Trade Estimates Barrier report noted that, quote, Korea's strict privacy rules effectively require financial services providers to locate their servers physically inside Korea. And in China, the storage, management, and analysis of personal, financial, and credit information collected in China must be carried out within China. More broadly, China has indicated that cloud computing, regulated under its internet data center licenses, generally remains off limits to foreign suppliers. And apart from countries that have enacted explicit barriers to cloud computing or cross-border data flows, we see other parts of the world where forms of digital protectionism as industrial policy has appeared. So when the French culture minister, France Perline, calls for, quote, les clouds souverains, or German policymakers call for creation of a Bundescloud, or a Schengen zone for Europeans' internet data. These types of policy proposals would balkanize global service markets, including for financial services. At ITIF, we view them as misguided, and therefore it's imperative that in the trade agreements we pursue going forward, whether the Trans-Pacific Partnership Agreement, the TTIP, the Trade and Services Agreement, that these agreements include strong trade rules that establish the foundational underpinnings for the global digital economy. These include, not least, ensuring non-discriminatory treatment for digital products and services, preventing countries from enacting requirements to use local computing facilities or to store data locally in the provision of commercial services as a condition of market access, prohibiting countries from imposing customs duties on electronic transmissions, and stipulating that countries who join these agreements join the Information Technology Agreement, which removes tariffs on the foundational ICT products that underpin cloud computing in the first place. Now, in the TPP, unfortunately, there was a carve-out made for the financial services sector that would have allowed countries to continue to impose barriers to cross-border data flows when it came to financial services. We believe this was a misguided idea because the carve-out threatened to validate the erroneous belief that storing data outside of a country is somehow inherently riskier than storing it locally. Moreover, that policy could have given countries a free pass to require certain data to be stored inside their borders, which would have raised costs for financial services firms, which would have only been passed along to consumers. It is good then that the administration has agreed to try and fix this, whether that is by including in TISA, this prohibition against cross-border data flow restrictions in the financial services sector. And for those 4 countries that aren't in TISA, Malaysia, Brunei, Singapore, and Vietnam, the administration has said it would work with these countries in their TPP implementation plans to address this. So then in conclusion, I would just say the financial service industry's use of cloud computing is just beginning to take off. But if it's to flourish to the fullest possible extent, Steve, this is going to require a 21st century trade regime updated to reflect the realities of modern global digital trade.
Thanks, Stephen. Vijay, you've had years of experience in applying information technology in the financial services sector, so if you could share your thoughts from the sector view.
Yeah, let me start with talking about MasterCard. So we are celebrating our 50th anniversary this year. If you look at the global data flow, MasterCard built the state-of-the-art global data flow system 40 years back because our business is based on having the data flow freely across the borders, because you may take your card and try to use it in some country about thousands of miles away from here. Still it works because the network is connected and we process them within 130 milliseconds, and the message goes back to whichever terminal you are trying to swipe your card. And today you'll use a chip and other things, right? If you look at that and look at the things that are changing globally from the nationalism perspective, MasterCard does business in 210 countries plus territories. So if even half of those countries want to keep their data inside their borders, irrespective of which technology we apply, it is almost impractical to do that. So that means you cannot conduct global business in that type of scenarios. So the public policy has got a lot of impact on global companies like MasterCard. So it's very important to know that. So then, if looking at the numbers, MasterCard processes about 160 million transactions per hour. That's a lot of transactions. And $4.5 trillion of transactions flow through MasterCard every year. So last 2015, that was the number, right? And there are about 2.3 billion cards, MasterCard, issued across the globe. So that is about the volume of the transactions and the financial activities that is generated by MasterCard. That is, most of the time we look at MasterCard as how do we pay for the goods and services. So there is other side of the MasterCard that is also important, that is important for the public policymakers too, because we help governments to distribute their benefits electronically so that they can reduce the fraud and the corruption in the system. So that is also key. Then coming back to the importance of data for the global companies, especially the financial services, you have to take fraud out of the system. To take fraud out of the system, you need to use the data to create fraud models so that you can detect the fraud when it is happening and you can stop it. And if you're not allowing the data flow freely across the border, and if you don't have enough data to create those models, then your fraud models will not be as effective as they need to be. And the coming back to the cross-border type of activities that happens, MasterCard growth is about 12% annually, year over year, in the cross-border transactions. So all these things, I'm giving the MasterCard example. This will be true for most of the global companies. So you can see, you can look at the MasterCard example and you can picture any other global company which does this type of business, right? Then the cloud technologies, like Stephen mentioned, will bring a lot of benefits to the financial services industry, but how the cloud technologies can be used in the financial services context is different, because the financial securities pay a lot of attention to the security, and they are in some sectors of the financial services, like brokerage, is highly regulated. And then most of the financial sector companies use the legacy systems, which are monolithic systems. Cloud technology by nature is a distributed technology. Let me explain that a little bit more. Distributed technology means you have small pieces of functionality that can be run across multiple cloud provider services. But if you have a monolith that is running on a mainframe, cloud technology is not the right thing. If you go to any big bank or any other financial services industry, their systems are running on, their applications are running on the legacy systems, which are mainframes. So that is another impediment, right? Then coming back to the next thing that Stephen mentioned, security. That is one of the impediments, but you need to do something different to manage those security, especially when you're dealing with the financial type of data. So most of the companies don't want to invest in it, because investment is, they have already invested within their data centers, and it is difficult to reinvest and get it into the cloud technology type of the capabilities, because their investment dollars are stretched between how do they grow their revenue or how do they deal with the regulatory compliance. Because when I used to work with a brokerage company, 20 to 30% of their technology spend on providing the regulatory compliance type of capabilities. And the rest goes to the revenue growth. So it's a difficult thing to set aside the investment dollars to move into the new types of technologies. And then if you look at the other aspects of it, we have seen some big news about some of the cloud providers had some operational difficulties, right? So in financial services industry, the people don't want to have any operational disturbance. So those are all some of the impediments, if you look at, in a broad sense, why financial services are still slow in embracing the cloud technologies. But the cloud technologies have come a long way in the last 5-6 years. So now they are ready to jump onto it, but still it'll take some time because of all these reasons.
Thanks, Vijay. You've given us a number of reasons why the take-up of cloud has been somewhat slower in financial services. Security obviously being a big piece of it. Could you say a little bit more about the regulatory aspect and compliance? You talked about such a large percentage, 20 to 30% of an investment going into regulatory compliance. Is that one of the biggest, or how does that compare to some of the other reasons that are getting in the way of cloud?
Yeah. So now I'm going a little bit beyond the payment industry because I worked in the other financial sectors, right? If you look at the controls that you need to apply for the regulatory compliance, those controls are applied in the existing systems, and they're all monolithic, they're baked in. And how do you remove those controls and the business functionality and then move it into the cloud is a big job, because you need to re-architect and redesign your systems. You have to spend tens of millions of dollars to do that. That is one of the reasons why regulatory compliance is one of the big impediments.
Stephen, you mentioned earlier some of the cross-border data restrictions. You mentioned a number of countries. Obviously, financial services is a sector that is highly regulated. Countries are looking at it and want to make sure that the financial services sector is secure, the financial systems are secure. Could you say a little bit more about some of the things that you've looked at from the policy side in terms of these barriers that you're seeing, and then talk a little bit about how some of the trade agreements that we've been talking about, new rules in trade agreements such as TISA, could maybe help to alleviate some of those barriers?
Yeah. So countries that put in place these types of data localization barriers really only add significant costs to their own economy and the enterprises that are competing in it, especially the SMEs. So the damage that's done is done to both global companies that would like to compete in foreign markets for financial services, but also to domestic enterprises that need access to information technologies to effectively compete. So if you look at research, for example, from the Leviathan Security Group, they find that when SMEs and countries are forced to use local providers as opposed to global best-of-breed cloud providers, that can increase their cost of doing business by as much as 30 to 60%. And when you aggregate that out to a broader economy level, you find research such as from the European Center for National Political Economy, which looked at the macroeconomic costs that forced data localization policies impose on countries. And in their report, the cost of data localization, a friendly fire on economic recovery, they find that economy-wide data localization laws can drain as much as 0.7 to 1.1% of GDP from developing countries' economies like China. And, quote, in their estimation, any gains stemming from data localization are too small to outweigh losses in terms of welfare and output in the general economy. So the point is that these data localization policies really inhibit the ability of domestic firms, whether in the financial services sector or others, to effectively compete in even domestic or global markets. So they set these countries back. TISA, as well as TPP, would put in place much clearer prohibitions against countries' use of policies that would mandate the use of local ICT facilities and the provision of internet services, whether that's Facebook or Twitter or financial services. It would require that countries have a starting point of openness to cross-border data flows. And it would also have a number of other positive effects in ensuring competition in the network competition in telecommunications sectors. So it would create the enabling environment for cloud computing to flourish.
Thanks, Stephen. Vijay, I want to see if you could comment a little bit more on sort of these self-imposed costs by countries that may prevent cross-border data flows or perhaps prevent the use of cloud computing in some of these services. You talked about operating in 200 countries, and it's simply impractical if you've got to store data in any large number of those and do the processing there locally. Plus, you lose the ability to aggregate data for fraud detection, for example, in your modeling. Looking at it from an electronic payment system or from banking or insurance, I don't think you've had experience in the insurance sector necessarily, but how are countries, if they restrict those global providers in those essential services, how are they hurting their own economies?
Yeah, because I think if you look at the financial services is part of any commerce, right? So if they cannot help the financial services to be global in their local economy, they are preventing the e-commerce in their local economy. So it's two-way, right? The goods cannot be bought from outside and brought into the country, and it cannot be sold from that local country to outside. So because if you don't have a way to do the financial services, which is global in nature, it stifles the whole economy. And coming back to just the payment industry or banking industry, you can say, for example, a citizen of that country which has got a lot of restriction, travels abroad, he cannot access the financial services provided even locally, right? That will be that restrictive. So then the whole thing falls apart.
That's a good point about global travelers, many of whom are in the room today. So I think you personally understand the importance of data flows in this context.
Steve, I wanted to pick up one thing that Vijay said, because you raised this question of, where does the money for innovation come from? And I know in corporate America, a lot of companies like General Electric use a strategy that the savings they are able to accrue from efficiency improvements, like Six Sigma and quality in their core business, is where they get the money to fund, downstream, next generation innovation. And if you hear Barclays talk, and they talked about how their cloud computing implementation would be able to save 90% on their baseline IT cost, well, now they're going to be able to use those funds to reinvest in new generation products and services for their customers. And actually that concords with a recent Dell study, which found that SMEs that use cloud computing services or have created cloud computing applications for their customers earn revenues 45% higher than peer companies that do not. And especially for SMEs, the ability to leverage these types of cloud computing technologies that decrease cost and give them access to infinitely scalable, on-demand, pay-per-use computing really increases their ability to compete. And that's why it's so pernicious when countries put in place these types of policies that preclude these companies from availing themselves of these tool sets.
So, Stephen, I'd like to flip this now. We've been talking about barriers and costs that are imposed by countries on themselves by putting these handicaps in place. Do you have some thoughts on positive, proactive policies that governments could take to promote the adoption of cloud, including in the financial services sector?
Sure. I think one of the starting points for governments is that they can be an early adopter of cloud computing technology for their own transactions. For example, state or federal governments could enable a universal mobile payment option for all government services, allowing users to either pay their taxes, for example, or collect unemployment insurance via cloud-based applications. So government has a role to play in being a first mover and early adopter in the adoption of cloud technologies that grow its use in the financial services sector. I'd also say that governments have a role to play in being permissive of financial services sector innovation. So there was a seminal report written by Steve Bartlesman for the OECD in 2002, and he addressed this question of the rates of innovation between the United States and Europe. Do European or American firms have greater rates of innovation? And what he found was that the rates of innovation of new product conceptualization were actually the exact same between European and American firms. And it was actually our ability to more seamlessly flow labor and capital into the most promising companies that made the difference. But Steve gave the apocryphal example of ING Bank. In 1996, ING Bank was the first bank in the world to offer an online banking solution. So ING goes to the Dutch regulators to get permission to introduce online banking, and they essentially say, well, no, you can't do that because you're going to put tellers out of business. So ING came into the US and introduced it first, and America had the first online banking service. So having an environment that certainly respects privacy and maintains security is vital. Creating a permissive environment for financial services innovation is an important role to play.
Yes, Bob. If you hold for the microphone.
Thanks. Bob Vestine, Georgetown Center for Business and Public Policy. So I've had a flashback. Around 2000, maybe 1999, maybe 2001 or two, electronic commerce came onto the scene. Let's say whenever it did. I don't know the date. I went to David Hartridge, who was then the director of the WTO's Services Division, a brilliant Brit. I don't say that often about Brits. No, I'm sorry. A brilliant guy. And I said, David, where does e-commerce fit in the GATS? What is it legally? Where does this, what's going on here? He hadn't the slightest idea. I mean, admittedly, nobody knew. So now we are where we are and have annexes and a lot of legal work, international, global agreements, discussions about data flows, et cetera, all the things you've been discussing. Is it time to go the next step, I hazard to say, and have an agreement solely dedicated to these issues that would be flexible, expandable, mutable, not bound into a TISA or a TTIP or another framework?
I'll say maybe. I want to turn to Stephen because I think he has some thoughts on this, and then I may add to this as well. We were going to talk about kind of forward-looking policy options. Do you want to take the first shot at this?
Yeah. I actually had the pleasure to get invited to Geneva about 3 weeks ago to give a presentation on the Information Technology Agreement. But while I was there, of course, for the WTO public forum, there was much consternation, of course, about the future of the WTO agenda. And I can tell you that the thinking there was, can we develop an e-commerce agenda going forward? And I know that's going to be a focus of a working group at the WTO over the next year. Certainly agree that the current trade rules we have in place to support global digital trade are inadequate. One thing ITIF has proposed that we do is create a data services agreement for WTO participating countries to protect cross-border data flows and prevent signatory countries from creating barriers to them. In effect, this would be akin to the Information Technology Agreement, which, as you know, is an agreement signed by 79 countries that eliminates tariffs to trade in information and communications technology products. Essentially, a data services agreement would be an ITA for data. And if we did that, that would actually give companies a private right of action to bring WTO cases against participant nations that would violate the agreement and would provide a disincentive for signatory countries to implement these types of trade distorting data localization practices we've been talking about. I think maybe one other idea related to that, but somewhat different, is that the United States should engage its trading partners in creating a Geneva Convention for the status of data. The purpose of this convention would be to establish international legal standards for government access to data, as well as multilateral agreements for questions of jurisdiction and transparency for data. Essentially, this would address like MLAT issues, but have a global agreement among our trading partners behind handle this.
The answer is yes.
Absolutely.
I'd like to add a little bit to that. I'm not sure how long it would take to negotiate such an agreement. We don't seem to be able to do anything in trade very quickly. But I feel compelled to point out that we do have in the GATS, under cross-border Mode 1 commitments, the ability to deliver services via the internet. The internet wasn't mentioned in the GATS in 1994 as a means of delivery, but it was looked at as technology neutral. So we have that capability, we have commitments there. I think the point of a lot of the discussion here today is the importance of digital trade, the importance of cross-border data flows is so exponentially beyond what was possible when the GATS was negotiated that it's time to take a serious look at what more do we need to expand that. Hence, approaches in TPP and what's being looked at in TISA and eventually TTIP. But perhaps in our future in the WTO, there's a multilateral data flows agreement, digital trade agreement. But I won't look for that anytime soon, given the way things move in Geneva. We'll come back to audience questions again in a moment, but I want to give our panelists an opportunity to address a critical issue, and that's data security or cybersecurity and data privacy protection. There is often a reaction among policymakers that we need to keep important data here at home because it'll be more secure if we have it on a server in our country. Let me ask Stephen first to address, is storing data locally the way to secure it? And is that all you need to worry about? Then I'll ask Vijay to add his own thoughts to that as well.
Yeah, as ITIF wrote in its report, The False Promise of Data Nationalism, there's absolutely no increased privacy or security that results from mandates that restrict data from leaving a country. The reality is that it is the technological and procedural methods of storing and transfer data that determines how safe it is, not the geographical location in which that data is stored. And in fact, as research from Gartner points out, most security breaches actually happen in on-premise data centers. So most security breaches actually occur in situations where companies are being forced into non-market-based transactions, and you actually get much more security when you're working with vendors that are capable of and familiar with deploying global best-of-breed security practices.
Vijay?
Yep. The security is an important thing. Irrespective of where you store your data, you have to make sure that the data is secured at all its life cycle. So I'll try to abstract it a little bit. When the data is moving from one place to other, when a consumer or within the business, you're trying to access the data moves in the wire, right? It needs to be encrypted and protected. When the data is in the databases, it needs to be encrypted and protected. So most of the time, people will try to protect the walls, and the data itself is not protected. How do you make the access mechanisms quite secure? And how do you make sure that the data cannot, even if you access it, you cannot read it? It's in an encrypted way. And there are multiple mechanisms you can use to protect the data. The location is not the only thing. Just because you got a server under your desk doesn't mean that you got control over the data in that server. Coming back to the cloud technologies, one of the things that some of the financial industry firms are trying to do is to add a layer of security on top of what the cloud service providers provide. So Stephen talked about the PaaS, or platform as a service. That is the place where they apply that type of security, as well as they also apply some mechanisms through which you can keep your applications or services restricted to a local region or make it global. So these are all the capabilities that the cloud technologies bring to the table. And to apply that type of capabilities, you need the right competencies and the skill sets. We heard this morning that the competencies become important as we move into the new technology era. That is in short supply to an extent. So that's one of the things that we might work on.
And Vijay, when we spoke earlier, you talked also about access to data by regulators. And could you just comment on, does that mean that data's got to be locally stored, or can it also be stored in the cloud elsewhere outside of a jurisdiction and still be available?
Yeah, it doesn't need to be stored locally, right? So if you use the cloud technologies, it could be stored in multiple places across the globe. And if the regulators can access the data for their regulatory purpose or for supervision purpose, then it serves their public policy requirements or the needs. It doesn't need to be in that particular country or locale. But you don't want it to be in one country because it's always a difficult thing, right? So if something happens in the from the geopolitical sense, you will not be able to deal with it. But it doesn't need to be in their country to access it.
All right, that's an important point.
Yeah, and Steve, it's the same with
Yes, please.
privacy. If a U.S. retail bank decides to store a customer's data within Canada, that does not absolve the U.S. financial service provider from complying with the privacy laws of the United States. And so as long as a company has legal nexus in a nation, it is subject to the privacy and cybersecurity laws and regulations of that country. Moving data overseas or storing it elsewhere does not give the company a free pass to ignore a nation's laws in these areas.
Thanks, Stephen. Let me turn to the audience to see if there are any questions at this point. While you think about potential questions, let me go back to Vijay. You've given some examples of how cloud is being used a little bit today. I wonder if you could look to the future a little bit more. When we were speaking earlier, you talked about the importance of being able to use cloud increasingly in financial services. I wonder if you could, first of all, say why that's important to be competitive. And second, what do you envision happening, say, over the next, 5, 10 years in the adoption of cloud and financial services?
Let me start from a couple of years back and then move into the future prediction. So about 2, 3 years or 4 years back, most of the financial services industries used to use the cloud only for some benign type of applications. For example, a public website, which is public to everyone, they can throw it on the cloud provider and then have those web pages in there. And recently, some big banks have moved their analytics data into the cloud, like Stephen was mentioning Barclays Bank, and there is another public information that Capital One is using the Amazon Web Services to a very great extent do their analytics. They are doing that by applying the stringent security on top of what those cloud service providers are already providing. So moving into the future, Steve asked the question, what is the imperative? Why do we need to do it? Like any other industry, there are disruptors, right? They are getting this compute capability at a very small cost. And they will be disrupting this industry if we don't try to adopt that, because having your own data centers in multiple places across the globe is not economically sustainable. So that brings to the point that the financial sector companies have got more what you call the inhibitors or the impediments for using this type of technology. They need to look at the cloud technologies as a whole, and they need to have a strategy in place how they are going to use it. So the several things they need to do. They need to break up their monolith mainframe systems and make it cloud ready. And then they need to build the middle layer platform as a service thing that Stephen mentioned to incorporate the security, scalability, resilience, and the operational readiness type of things. And then they can start using this on-demand elasticity, right? Again, what is meant by that is they should be able to consume the compute as the need grows, and then they can give up as the need subsides, right? That way you are paying as you go. So you can compete with the disruptors who have got that capability because they are starting with the cloud technologies from the get-go. For the companies that are in business for 40, 50 years, they need to have a plan to go there. I think many companies have started in that direction, but it'll be interesting to watch how quickly they can move.
All right, thanks, Vijay. So we've got a few minutes that we could take some questions from the audience if there are any at this point. So any questions? Okay, well, if not, please join me in thanking our panelists today.